That's the first financial sheet you should study and have it embedded in. And then you start looking at investment spaces, investment scenarios, asset classes, right? What is the risk taking you have? If you understand your personality, there are also personality tests. Take a personality test on that, especially with related to financial risks and your response to different degrees of risks. Take that personality test. There are many available now, so you will know exactly which spaces, which asset classes will suit your personality. I'm not saying you have to follow it 100%, but getting an understanding of what you are when it comes to investment is a very good thing to have in your mind all the time. No,
How's everything going?
my parents are arriving in New York. I'm traveling. So
Oh,
that
okay. Yeah.
there's so many things
No,
to
no,
complete.
no issues. Yeah, I know. Well, to get this session, you've been really busy, so I know how it is. That's okay, and I can only say thank you for
No,
for
and
making the time and making it work in your availability.
like I was in the middle of selling 6 deals, so it was crazy busy. You won't
Yeah, yeah.
imagine what I went through.
No, I don't. So, but before that, and I want to know. So, Hemant Pawar, you are what I have here as you come from the tech world, right? You were an IT program and director for major tech companies. That's what I have here. Uh, well, serial real estate investor. That's pretty clear, and we'll talk about it. You have scaled to 2,000 plus properties. Uh, and you also run a private charity organization. Is there anything else that you're doing now?
Well, I'm trying to scale down my
Scale down.
portfolio, trying to free up some time and effort because the market was so crazy. Um, but first of all, let me say thank you
That's
for inviting on your platform, because it's an honor and a privilege to be here. And I know
oh,
you have started this journey in a very unique, creative way. You are listening to stories. You are not jumping onto doing anything quickly. You're just understanding the space and people experiences and background. So I'm very happy that you are taking this journey through this route, because I started like go go go, and I think I should have taken a little bit more time before instead of speeding on this path. But yeah, again, thank you for inviting, and I look forward to this episode.
awesome. Then a segue. Why do you think you should have started slowly? Were you too eager to start things?
So more than yes, I'm an action taker. I usually like to do things first, and then think how, and then kind of re-strategize or learn from mistakes. That has been my personality all my life. um, but what happens is, when you are dealing with different domains, you can do that in your professional work. Maybe you lose some time. You can do that in your personal work. Maybe some relationships will go in up and down, and you can bring them, make them smooth again. But what happens in the real estate world is, if some lessons learned, if they impact your deals, your assets, it takes a long time to correct them. It also it also creates hurdles for investor returns, which is something that is an additional liability on you, or I would say responsibility on you. um, and you need to tune your personality accordingly. So, which is why I mentioned that if I had gone a little slowly, I would have caught some of the mistakes that impacted my deals, over a period of time. I would have probably spoken to a few more people, and they would have shared experiences which would have showed me that certain things may happen on my deals too. um, or I would have probably taken better, more care in in selecting the partners who up, because all partners appear very nice and friendly and honest when you're talking, but when things actually are not going well, their personality changes. you know so so you really need to spend time in understanding all these things, and that's the reason I say that, I wish I had gone a little slower. Not that I was in a loss making situation, not that I lost anybody's money, but it definitely impacted the deals in such a way that we had to spend 10 times more time and effort to even manage that deal. So just because of certain things that I missed, or certain lessons that I learned being a newcomer a few years back.
Okay. Yeah, one of my guests were Kobe Bowers, and he said the same thing about partnership. You should, you must do partnerships. They are great, but yeah, you must select carefully. Yeah, and the reason for you to sell these properties, it was scheduled. You wanted to do it, or it was a response to what is happening with the market now.
See, I'll say one thing, and that is the first lesson I learned on my own. Nobody told me, but I was looking at the way things are going on when things don't go as per projections. Always think about the investor first. Forget you are an operator, fund manager, GP. That's a title that comes last. Your number one priority is investor returns and preservation of investor funds, right? So now that we know that the last three and a post COVID real estate market was an anomaly, is still an anomaly. Nothing cash flows when you buy it. You have to put in a lot of time, effort, money um, to bring it up to a certain stage. I won't say nothing cash flow, like hardly, hardly anything cash flows from day one, the way it used to pre-COVID, right? So the reason we started selling is now that we know that certain states and certain areas have crashed. They went way up during COVID, and everyone was on a buying spree because the whole world and their mother jumped in this space during COVID. So sellers are getting 40, 50 offers, for their deals. That, and I've heard that with many brokers. So now that we have gone through this period, and then now the market is restabilizing after changes in the financial market, the way the interest rates are, the way some of the markets have fallen, uh, especially in Florida and Texas, where the rents are going down now. So, that has kind of influenced me to go and check again on what exactly is happening on these deals. What do the projections look like? What are we promising um, these investors? What was projected? Where our current situation is? How it may go? Right? What are the additional risks that we may take? Um, so when we do that analysis, you come to realize that nobody really knows. Even the senior most 10,000 plus units people, then nobody could predict what happened in the last 3 years, and they even cannot predict right now, right? It's all a marketing jargon that's going on. So as an investor who has a financial background and a projection and budget management background, look at the current analysis, look at the risk, look at how the rents have gone down, look at the delinquency rising, look at the current administration policies that are affecting this space, and then think, what does the future hold? What are the future risk projections, and whether we should be going back to investors and saying that we could not meet your projections till now, and but we will need to hold it longer because real estate always goes up and down. And I'm like, if I give somebody 100K and they come back with this reason, I would be like, forget it. Just return my money. I will go and double it in the stock market or anywhere else, right? So most of my investors are sophisticated. They know how to invest. They know it. So if your properties are not meeting projections for whatever it may be, maybe your due diligence was not good. Maybe the market went down quickly. Maybe you didn't buy it properly because everyone was buying it at that cap rate. Then now that you know so much, now that within so few years, if my experience actually with so many lessons learned, spans across thousands of units, then I want to be honest to myself, truthful to myself, and then see what would be the best solution for the investors. And that's how I took the decision that we should get the investors out first, because the projections are still 50-50. Nobody knows how it's going to go from here. And whatever they have got, the cash flow so far, it's fine. After the returns, if my GP share comes or not, does not come, it's still fine. I just want to make sure that we take a sound judgment on the risks that are involved. There are other partners who would love to keep them holding on for 10 plus years, because their GP share is locked in, thinking that things will turn, but nobody knows. I'm telling you,
Yeah.
nobody knows how the market will. First, have to think of the investor and take the right decision at the right time. With And it's okay. Tomorrow market goes up and you are like, oh shucks, I hope we didn't have it. It's fine. You took a decision based on what you knew, and you preserved your investors' capital, number one, and whatever returns they got, right? You never had a Nobody had a crystal ball 4 years back. They don't have today, and they will not have 3 years down the line. With the current, that's how I look at things. Put myself in the investor's shoes. I myself invest in my deals, so I always put myself looking at my money and looking at what's going on. I decide which deals to sell, which deals to keep. Sorry, that was a long answer, but I wanted to cover all aspects.
No, of course. But what you were saying is what you learned, and nobody exactly told you clearly like that, was pay attention to the investor.
Yeah,
Is that
yeah,
right?
yeah. Investor first approach. Yeah,
Investor first. Okay, investor first. Yeah, no, that's great because as you were saying about my idea here is exactly that. I'm trying the while networking, while networking, which is so crucial. I have been in contact with amazing people, and all of them has amazing content. So it's that experience that I'm trying to bring here.
yeah,
Things like that, which is priceless. So yeah, um, you already told. I wanted to ask about what the greatest challenges you've had so far. Maybe you will answer that it was the preserving investors' capital. But is there any? No. But before that, I was thinking while all of that was happening, I am curious about what was your mindset. So
so
I understand you were having to adapt to the situation. What was your mindset doing that?
while adapting, always look at the foundations. And I have this habit of always looking what was and what is. So I used to go back few years. I took their underwriting. I took that deal analysis, and I share it on my platform also many times. At some of the deals which were making like 10-15% returns on day one without doing anything, right? And today your 10% might come after 5 years after working a lot. So when I saw that discrepancy, then something encouraged me to dive deeper, look at the financial baselines, right? And I just mentioned something in one of the group chats, and so many people called me after that comment. And I said, what I have found, and the biggest lesson I learned was, pre-COVID, only two or three states were trading at 4 cap. New York, California, some parts of Seattle. So they used to trade at 4 cap throughout. Like an average. The US average was 11 cap. US average
Wow.
was 11 cap. Post COVID, half of the country started trading at 4 cap. For what? Was there any reason for that? Was there so much of resetting of baselines, or did the financial center suddenly move to the south? No, they didn't. Or did the economic center suddenly started moving here and there? Yeah, I mean, sure, there was some activity, but nothing warranted that kind of change. So and that is what is happening in the current market, where now when things are resetting, people are coming back on the ground, trying to face the reality. The COVID euphoria is over. Many people have burned their hands in deals. So many foreclosures you keep hearing about. And even my deals, I mean, I'm honestly the GP share hardly came out in some of the deals that we sold. The GPs didn't make anything, but we saved our time, effort, and energy for the next 3 years, instead of just riding a slow horse. Because there are certain markets, which were like the darlings during the COVID era, but when they have gone down now, we know history says, and historically, if you look at the data, these markets take a long time to come back. That's why there are, there's a reason New York, California, Seattle, it's more of how the money stays and money plays around those areas, which keeps the cap rate that way, right? So that was my the first first thought process, when I was doing this. Sorry, while talking, I forgot your main question. What was the question again?
No, I think you answered. It was your mindset. What I'm getting is you went back to the basics and you analyzed. Okay, that was the analysis I did. That was the promise. Where we are now, and so you didn't panic. You just relied on data.
Yes, and it's nice to hear people leaving their jobs and financial freedom within a year or two. But when you start looking, people did that pre-COVID. Post-COVID, I hardly saw anyone who was like a regular professional like me and left their job just because of this space. They may have lots of savings and they may be doing dabbling in different things, but I haven't met anyone who went through this from zero, and managed to come out financially free. And the other thing that, in conclusion, what I would like to say is the uh, the key aspect is, you usually want to invest for the future, or you go into a market knowing that this market will go up, right? You don't go into the market when the market is already up, which is what most of the newcomers did in the last 3.5 4 years, right? So all the single family or people sitting at home thinking about how to make passive income jumped into multifamily, because the marketing was cash flow, and multifamily gives you more. The marketing still goes on, which is quite strange, because I know many people who are making a killing in single family, or just doing fixing and flipping, right? So all spaces are good. Uh, but the key is now, and then people realize, oh, okay, this is not giving what we need, and they suddenly move into a different space. For example, senior housing. So who knows, or who can say whether the senior housing is at what point? Is it at the point where it's going up, or is it at the point where it actually is already up? So people should make that analysis. The reason I haven't touched it yet, because I didn't get time to do that analysis. I'll see what is, and what are the factors impacting that space. Today we know multifamily, even the construction market, you see all these undocumented immigrants being picked up, and construction sites are in shambles. So many of them. You just Google it and you'll see the news. So that's affecting the construction industry. The labor cost has gone up. The rehab cost has gone up. Vendors budget estimates have gone up. Delinquencies are rising right now. If you see, most of them will say delinquencies are rising across the board, right? So when you look at all these factors, and then you kind of project the next few years, and then you see whichever space you take, whether it is senior housing, multifamily, single family, veterans housing, residential, assisted living, whatever it may be, you need to figure out what point you are getting in. And that can happen only when you analyze the last 5 10 years, and it's easy. You reach out to people and you'll get the data. That's what I did.
Yeah, yeah. No, I get what you're saying, and what was not necessarily is. That's why you, as my real estate mentor, is happy that I'm taking it slowly, because we need to learn how to read the moment, right, and not necessarily jump. And oh, like we hear so many wealthy today, they did in the past not exactly what they did. We have a lot to learn, but that's also what I want to bring here. What is working today, right? There are lessons, always there is, but we have to be careful. So that's what I get from all this.
Yeah. And to your point, it's not, I hope I'm not sounding discouraging. I'm encouraging people to tune their expectation. Like, if you have come into this space thinking of something, then at least go and find out whether what you were thinking of exists or not. Right? And whether it is realistic or not. And if it is not, then what is realistic today? Right? And then when you accept that reality, you can tune your expectations and still move on this path. And it is a great space to be in. You'll meet great people. You may make a lot of profit, the market supporting, um, and you will still come out of this successfully. But the various levers that used to push forward the deal, what they were, what it is today, and whether your expectations match what your reality and your earlier um, motivation was. That's how people should proceed, by tuning their um, you know, expectations, as well as having a reality check.
Nice. Well, today you are mostly focused on real estate, right?
Yes.
Uh, what would you consider are the important traits to have um in commercial real estate to avoid failing or missing out on something?
If you are an out of state investor, then the number one thing is, you should know the numbers, you should know how to underwrite, and you should network and understand the partnership well. The reason being, in underwriting itself, there are a lot of elements that are taken into consideration based on the local expert's opinion. Many times, and this has happened in my deals too, you will be surprised that in some of the deals, the local expert's opinion itself was incorrect. So, how can an out of state investor, overcome that? Right? So you need to take that underwriting and apply your own limits and own leverages and own buffers, and say that even if this guy's opinion may turn out wrong, it may still work within this range, right? So because we have like a deal where, I remember the first call, and the local partner was ecstatic. We are going to raise it by $450, this that this location is great. And I wish I had gone and traveled to that location before the deal started. I went after the deal, because the way I can do a recce of the area, and the way I can figure out what's what and what is not. I don't think I can rely on anybody else, because when we came to know that the rents are not going above 200, 250, forget 450. And then when I visited the area, I could see why. I could see there's a, I always say this, there's a big difference between a gentrifying area and a gentrified area. Okay. You can invest in a gentrifying area thinking that now this area is going to come up because this is happening, blah blah blah. It's going to be um, all bells and whistles. But when um, uh, but when things change, that gentrification also hits a hurdle, right? And you stop in your tracks. When suddenly the county budget decides not to do that, or the kind of tenants that were coming there suddenly move somewhere else, or you go there and realize that the gentrification was happening a couple of blocks away, which is way different than what your block is. you know so once you see those levers, and you go at night and you see the kind of activity and the kind of people moving around, and then you realize that there's no way anybody would have paid 450 more here. And the local partners was just wrong in their analysis, even though they were quite experienced. So, those kinds of things are important, especially for an out-of-state investor. So, underwriting, knowing your partners well, and having some physical presence in the early stages of the deal, just to go and see whether it matches your expectation criteria, and you feel happy, if happy and proud while taking that deal. So that will really help. These three things are key. Um, and then if you are raising capital, If you are strong on these two three things, you will be able to translate your confidence into getting investors on board, right? Because if you can confidently tell, hey, I looked at this, you won't believe so many people who invested with me out of state. They used to ask me, have you seen this? Have you looked at this? Have you traveled here? In fact, one of the deals which was going slow, so many of the people used to say, you have not even visited the deal or the property. Because I was very honest. I said, yeah, but there are four local partners. Why does a fifth one need to go there, right? But 1 year later, even I visited that property. Even I took a 4 hour flight. I went there, even though I didn't need to become a part, but I still went. I took pictures. I sent it to my investors. I told them honestly what I did not like, what I did like, because finally they invest in you, right? So for them, you are the whole, uh, the main point of contact, and you are the one who is managing their money. So you have to build that confidence also, and you won't believe many times how what a different perspective you can give to the local partners who, maybe they have a narrow perspective being there, but you bring in a totally fresh perspective. And many of my deals that we sold right now, I think the local partners were, you know, short, fell short in some of the things that would have made that deal better.
Now, I'm curious if you were to, okay, it's a newbie scenario. Would you prefer would you prefer to have like 10 units, 100% yours, or 100 units in any model, JV or syndication, but 100 units where you have a percentage? What do you think is
I
better? But better is, relative. But
yeah,
you
yeah.
know,
I would say what will give you better experience to grow bigger. So so what I would suggest in that case is, even if you buy a 5 unit of your own and you go through the business plan, hiring vendors, contractors, property managers, looking after the rehab, raising the value, maybe refinancing. If you do it on your own, you will come to know 90% of the things that you are anyways going to do on 100. Maybe you will not be using AppFolio or any other kind of Yardi or those property management systems, because you won't need to. But apart from that knowledge and that space, you still went through the hands-on practical experience, and maybe you learned lessons, maybe you made mistakes. But when you apply that, um, and you raise capital, or you are into asset management on 100 200 unit, you can actually start figuring out the budget, the estimates, how much the reserves are, how much reserves you will need, what kind of risks may come out because you went through it on your own property, right? Just as an example, one of my students was showing me. I said, "Hey, we found something, a nice deal, and let's analyze it." And in the coaching session, I said, "Sure, we let's meet now," because many times they don't want to meet quickly, and I always say yes. Uh, they opened the deal, and the first thing, even before they started going describing that deal, within a minute, I said, "Why are there so many staircases?" The whole picture, it was all of staircases, these wooden staircases going around the whole block. And and they were like, "Yeah, we didn't, that's interesting, we didn't think about it." And I'm like, "What's the problem?" Like, I told, so one, that is a huge maintenance issue. The second one is, obviously, it looks a little uh, congested, the whole design of it. And third is, I have had experience where we went through a due diligence of a similar property, and we knew that, some of these wooden railings, wooden things we need to change. We estimated that in the budget. Even the contractor inspector walking with us, he went through all that. And when actually, we took over the rehab project, or the the capex project for the staircases. When we pulled out the staircases, half of them were rotten from inside. So that
Whoa.
12,000 budget went to 42,000 overnight, right? So, so, if I had something like that on my own, it's all on me. I don't, it's all, I learned it. I learned the hard way. I'll put more of my own money, but and obviously you do in big deals, you do put reserves for such kind of things, but you get the knowledge on your own that this can also happen. So many hidden things come up. So if plumbing issues happen, leakage issues happen, the flooring gets destroyed, damaged, how do you kind of recover from that quickly, right? Changing the carpets, changing the vinyl plank, if that's what you're using. How do tenants treat these things? Do they really value the rehab that you have done? I mean, you can give a wonderful brand new property to some tenant and they will completely trash it. So what does it mean, when something, because in big multifamily, these things come up very regularly. Leakages, this not working, that not working, some mold in some areas. So what does it mean to clear that, to clean that? So when you know that, you are able to translate those issues to your. If investors ask you how is the property going, you can, when you share these things, they gain more confidence that this guy knows what he's talking. So
So basically the pros and both scenarios has pros and cons. Basically,
yes,
you said
yes,
what each way if you learn more, but depends. So
yeah.
okay,
And
yeah.
you can always hire a property manager for your own units also. But today, if I am completely fresh and new, then I would go this way. And if I had the money to go alone.
Oh, okay. So you're saying if you had the money,
Yeah, because
yeah,
a 10 unit, even like a 10 unit in, let's say, even in the Midwest nowadays is nowadays. Earlier, in 2-300K, you used to get a 10 unit. Now
yeah.
probably $1 million. So and your loan component, you never know how much you'll get, between 60 to 70, depending on how they look at you and your experience and your
Yeah.
net.
No, got it. Got it. Uh, I want to give you then another scenario, which is in what time frame do you believe? What time frame do you believe that you could redo all your greatest accomplishments if you were to start today?
If you
And maybe you
Yeah.
would do differently. That's why I'm asking. Would you do differently, and in what time frame? Let's say 1 year, 1 month. If you had to rebuild everything.
So if I had to do things again, I probably would not go after doing too many deals, just to improve my CV and my standing with the lenders. Um, because finally I came into the market for cash flow, and cash flow is what disappeared, which I realized very quickly. So I was trying to make different ways or go different ways to come to the same objective, maybe by becoming a GP and an LP on deals, or raising capital, or being a partner, right? But that stretched me a lot, because there are too many things to do. So what I would do is, I would just focus on the cash flow, and whether it is multifamily or any other space, and maybe do deals differently. And knowing what I know, if I have to reach this stage where I've managed 2,000 plus units, different kinds of assets, BC, uh, then I'll probably take a year to do the same thing again, as long as it is satisfying. Today it's been 4 years almost, but from what I have learned so far, if I have to start again, within a year I can scale back to what it is, as long as the deals are available.
Well, yeah, that we cannot control. We still cannot find good deals. But yeah, anyway, with that, I want to ask you what success looks like to you. What is success for you today?
So from whatever success I achieved, I mean, it was not all lost and gone game for me. Even though I sold 6 units and not many GP profits there, but from whatever I earned so far through putting together the syndications and managing assets and the investor returns and all, and I had a lot of freedom of my time. I could spend more time with my aging parents. Last 2 years since I have left my job, so that gave me a lot of flexibility. So that which I didn't have before. Um, so so kind of deciding what I'm doing with my time has been the biggest success. Forget the money part, but everyone needs to experience this phase more or less. You don't need too many things, but where you basically don't have any milestones put by your corporate world, and you are in charge of what you want to do and what you can drive for your own success, right? It's totally up to you. Your success is your responsibility, whatever space you choose. And if the environment supports that, then you can be one of the big stars of that space too. So that's what success looks like.
Yeah, I agree. Time freedom also, it's much more, I think, rewarding than than only money itself. Yeah.
And entering a new space and still surviving and thriving, that is a different kind of success. Then you feel, okay, I could do something. Tomorrow something happens, and you know another something COVID like happens, half the world disappears, and you are still alive. You can still figure out ways to stay alive and thrive. So, and that's a extreme hypothetical example, but we have gone through all of that, so that's what I say.
Yeah, yeah, and we survived. So thanks for that. Well, give us some learning materials that would you recommend. Could be books, podcasts, or anything that you like to consume.
Yeah, the first learning material before you read anything else is study your own income expense habits. Okay, if you have a strong hold on knowing exactly how much you need, where you spend, what is unnecessary, what is necessary. If you have that idea, go back to your spending patterns, and then make a future plan based on your current situation. That's your baseline. That's the first financial sheet you should study and have it embedded in you. And then you start looking at investment spaces, investment scenarios, asset classes, right? What is the risk taking you have? If you understand your personality, there are also personality tests. Take a personality test online, especially with related to financial risks, and your response to different degrees of risks. Take that personality test. There are many available on, so you will know exactly which spaces, which asset classes will suit your personality type. I'm not saying you have to follow it 100%, but getting an understanding of what you are when it comes to investment is a very good thing to have in your mind all the time. And then figure out, like I always say, if you are a fresh new investor, I would say put 30% in stocks, put 30% in real estate, put 30% in you know um, um, other asset classes, including your savings. Maybe buy some bonds. Keep your emergency after your emergency savings. That's how you should distribute. It's a common example. And then I would say, okay, then if let's say if it is stock market trading, then how you need to know how to read macroeconomic indicators, right? What does CPI inflation mean? What does PPI mean? How does why does the market go up and down after every Fed meeting? So there are many podcasts out there which talk about reading the markets and reading the macroeconomic. So that's one. So when you come into real estate, you have to understand what is it that you like. Do you like cash flow? Do you like equity built up? Are you a long term investor? Are you a short term? Are you buying for your own, or are you buying for investment? So based on that, there are multiple uh, resources and websites, right? When I started, I thought I'll do single family. I went to this website called Bigger Pockets. I read every article that they had, just as an example. And so I learned about cash flow. I learned about how people were doing deals, and that's what amazed me. People were making 400, $500 a door, right? Like one per unit in single family, and that's what attracted me. And then I heard somebody talking multifamily, so I moved to multifamily. But but these kinds of things, right? Everyone talks about rich dad poor dad, where you understand the cash flow concept and how you can grow on it. But it talks about the concept, and it talks about various ways of implementing it in your real estate journey. What it does not talk about is your risk appetite and your personality. Because I can tell you, when pressure hits you, when your money is not giving you the returns, or when you're not doing as you're expected, based on your personality, it impacts your attitude, nature, your daily equilibrium, mental equilibrium. So it's important to do that, right? Couple of other podcasts on multifamily are out there, where regular folks have done fantastic in multifamily. People leaving their W2 jobs. There are podcasts where fixers and flippers talk about handling multifamily flipping. One of my partners used to do that in Colorado, and very successful. You don't need to just hold, keep it as a long term thing. But again, coming back to how much time you want to spend and all, right? So that's the second resource thing. And the third resource thing is reading the environment. The third, like the podcasts or the books or series where it talks a little bit about your mindset, or how to be positive even in the situations that take you deep down this, because investments always have this cyclical thing, right? So some of those things that helped me was, one was the journey within, which is understanding yourself more. That was one of the book by one of the spiritual leaders. And there was another book where I forgot the name, but they talk about starting fresh in different investments, and they shared their journey. um, the name is not coming to me. I've read so many different ones, but that was good. Then Seven Habits of Influential People. That will teach you a lot about how these people came about to be, right? Uh, it does not talk about investment, but it really matches what an investor would look for in that. And then there was one book that really helped me, and that was on macroeconomics, like what I just mentioned, the CPI, PPI. When does the Fed increase rates? When they don't? Why they do that? Uh, you know, so if you just read something on that, that would be.
Great. Wow, that's a lot of content. That's great. Great. Yeah. I'll gather later for sure. And I liked a lot the suggestion about the investment profile. Yeah,
Yeah.
I think I'm
Yeah.
gonna search for that.
Investment profile is directly correlated to your personality, which is why so many, just as an example, half of my partners, they came into multifamily and they went back to fixing and flipping. They were very happy. They were like, multifamily is not my cup of tea. We don't like it. I'm telling you, it is about personality. Even stocks, the way people trade, it is about personality. So understand your personality and then jump into it. Right?
Got it.
I jumped into stocks without understanding my personality a few years back, and then when the market went down, I was like, oh, maybe I don't understand it. I sold it off, and today the same stocks have made three times the money. Now, I should have, what was I thinking? In few years, I lost so much. What was I thinking? So I wish I had understood my personality type then, and then kind of figured out how to grow.
Yeah,
But anyway.
that's a great suggestion. Um, any last thoughts? Would you like to share?
Well, I mean, we covered everything, but take it slow. Slow and steady wins the race. There's no winning. We don't want to win anything here. It's more of, you're competing with yourself. um, Look at the market, understand the macro indicators, and then play the game. Do not follow the trend. Understand what it was before and what it is now and its journey, so that you can project something for the future. Right. So, talk to as many people, understand their lessons learned, mistakes made, um, read as many resources regarding whatever investment you want to do, whether it is multifamily or real estate or stocks or whatever. Understand how the market goes up and understand the fundamentals of that business, whether it is underwriting or anything. And three, look at examples of successful or failed deals and try to find out why they were successful or why they are. I wish I had done that more. I did not do it more. See, when things are going good, when you are making 10-12% without doing anything on day one, you know, whatever happens, even if there are big upheavals in the property, you are still safe. But in today's market, where you probably may not make that much on day one, just as an example, and you have to put in a lot of work. It is finally about collaboration and teamwork. And I can tell you, you will be surprised. So many people do not have that quality. They show they have, but actually, when the deal is operating, they don't have that quality. So, so coming from the corporate world and managing teams working across 7-8 departments, it actually helps in understanding these nuances. But again, that's not like a criteria. I'm just sharing some warning signs.
No, yeah, no, that's great. Amazing, amazing story. Thank you for your availability. Thanks for sharing with all that with us. And yeah, I can
Thank you
only
for
be
inviting.
thankful. Thanks for your time. Really
Yeah, thank
appreciate
you
it.
so
It
much.
was a class. It was a master class about investing in real estate and mindset, motivation, everything.
Yeah, I didn't mean to make it a masterclass. I just shared whatever I learned. And like, my one of my platform, it is about lessons learned, mistakes made. We only talk about that. so
Yeah,
so but thank you for inviting me, and it's an honor and pleasure that you got to talk on this one. Thank you so much.
great. Thank you. Thank you, Hima. See you later.
See you. Bye.